today, and so the dominoes fall with Tarric Brooker. Hello again, it's Martin North from Digital Finance Analytics, where I this post covering finance and property news with a distinctively Australian flavour. I'm joined for our regular Friday afternoon chat by Tarric Brooker, journalist and data extraordinaire. Hello.
I wouldn't go that far, but I appreciate the kind welcome, Martin.
Great to have you back on again, and people love your charts and they love the deep insights that you share. So welcome back.
Oh, thanks, mate, and I really do appreciate the kind words from the community and their continued support.
Yeah, it is good, isn't it? And look, I always say there's a lot to talk about, but there's a lot to talk about.
Well, yield curve control blew up in the RBA space today, which was just, I'm not going to lie, I got a certain sense of satisfaction out of that, just watching it all go nuclear on them, and watching the 2-year bond go up something like, in terms of its yield, go up something like 600% or 700% in the space of about 4 days.
Well, it is interesting, and there's a little phrase about you can't buck the markets, right? And my analogy has been the RBA's sort of got this air-filled balloon, and they're pushing it down below the waterline, right, trying to keep it low, right? But the pressure is getting bigger and bigger, and of course, eventually they had to say, we give up. Whoosh, up it went.
Yeah, exactly right, and it's creating some fairly sizable moves. And I mean, I think it would be also important to mention that this isn't occurring in a vacuum. This is something that's happening elsewhere. In Canada, the Bank of Canada was forced to abandon QE and bring forward its rate hikes, and now there's a rising expectation that they could be rising rates as early as April, which would really start putting the cat amongst the pigeons in Martin Place for our own RBA.
Yeah, and the Canadian authorities, of course, have done a whole bunch of things that they didn't expect. But also now the Bank of England is sort of making noises about, well, maybe they're going to have to move rates up sooner than later. New Zealand's already gone, of course. Iceland's already gone. Speculation of more rates. Interesting to see what the Fed does, because, of course, the GDP numbers that came out overnight were actually, early draft, but indicatively not very good.
No, they weren't terribly impressive. I mean, one thing that's important to keep in mind with the US GDP data is, for some unknown reason, they choose to annualize the quarterly numbers. So while the headline was 2% growth for Q3, it's only about 0.5% in actuality, the way the rest of the universe measures growth. So a 0.5% growth after trillions of dollars worth of stimulus, after all this effort, all this song and dance, it's really not that impressive. And I think that these conclusions of stagflation, at least in the short term, are correct at this point. And the growth just isn't keeping up. And I mean, that's something that we've been discussing here now for 4 or 5 months now, with the charts to back it up.
Well, it's been quite consistent, because if you think about how much has been spent by the Fed and how little they've got for it, I mean, of course, you'll never be able to run the counterfactual to say, well, if they hadn't done it, what would have happened? Maybe there would have been an almighty crash sooner. But if you think about how much money they've just thrown at this, they've almost got nothing for it. And at some point, you've got to ask the question, why go on doing it?
Well, I suppose it depends on how you define got nothing for it. I mean, the wealth of the top 1% has risen to its highest level ever relative to the rest of the population, exceeding even the point that was recorded shortly before the Great Depression. So, that's a nice little indicator of what happens when wealth inequality gets too large.
And it's interesting, I've had a few people talk with me in recent times about the frightening parallels, in the early 20s and now, right? And a lot of the signs do look to be quite similar.
I think one of the things that's really interesting about now, and contrasting it with the past, is things are occurring so much more rapidly. We saw like one of the largest, drawdowns in the stock and bond markets in history when things kicked off in February and March of last year. And now we're seeing arguably the quickest bounce back from a recession into a rate hike cycle, which, as you say, is already occurring in places like New Zealand and will shortly be occurring in the UK, whether it's this month or next month. So it really does make you wonder, are we just on this accelerated timeline where things are playing out much, much faster than normal? And is that going to be sort of, our lot for this particular economic cycle? And that's one of the things that I find really fascinating about the interest rate debate is that, everyone's like worried about wages and all this other jazz. But I think as long as this inflation keeps feeding in from supply chains, we may not have time to wait for the wage inflation data for that to pick up, because obviously that's a lagging indicator. That's something that comes late to the party rather than something that comes first, at least in more recent years.
Well, that's a very important point you're making, right? There are different types of inflation, right? There is inflation, which is essentially, because of the supply chain disruptions, the transitory inflation, right? And then there's the inflation that comes through because of the cycle, and therefore you have to actually see wages going up because people are now trying to catch up with the prices that are rising. And unfortunately, if you look at some of the embedded data that we're starting to see, it looks as though some of that inflation is getting more sticky. And so the transitory story, I mean, even Jerome Powell is now saying, it's going on for a bit longer than I thought, which is one way of putting it. But we are now starting to see some interesting indicators. And I would make the point that the data that came out in Australia, with the CPI numbers, which was a little bit higher than might have been expected, but the rental number in there was almost nothing, right? And if you look at the rental data out of CoreLogic, right, which is looking at new rentals, it's huge. So we know that the CPI is understating a lot of the real stuff that's going on.
Well, that's a huge part of the problem, and one of the reasons why arguably inflation could become more entrenched over time. I mean, as you say, the rental component of the CPI came in at only 0.18% for the quarter. And if you ask pretty much anyone who's rented a property outside of, apartments in our major cities, what it's been like in terms of, rental increases, they would laugh at you. And they said, rents are only up 0.36% over the year. Meanwhile, as you say, CoreLogic say in terms of new rents, it's up 8.9%. So if this is going to something that's going to feed in over time as the componentry of the CPI functions, measuring existing rents, and this is something that's just going to feed in over the next 12 months, couple of years, however long it takes, you're talking about this inflation at the very least in the rental component becoming entrenched, becoming a factor that's going to continue to drive the CPI higher. I mean, and not only that, but you also saw clothing and footwear come down, 3.7% for the quarter. And that was something that dragged significantly on inflation. Otherwise, we could have seen it print, closer to 1%. So, I think that it's going to be a complex thing going ahead, and things might be a little bit more challenging than the RBA expects, although it's already blown up in their face. I mean, perhaps it can only get worse for them from here.
Well, I did say the other day, I think when we were chatting previously, on pay performance basis, I wouldn't have paid them anyway, right? Well, I will just repeat what I said, right? Payment on results, well, the results isn't what they expected, right? So, I don't know. What about accountability?
Well, I mean, it's like in a recent article, I referenced to them as Wile E. Coyote trying the same thing over and over again and having it continually blow up in their faces. But I think one of my favourite things about all of this is that if the RBA remains true to its inflation mandate, if it remains true to keeping inflation below 3%, now they're forced to be Wile E. Coyote the other way. Rather than chasing inflation, now they've got to try and get it under control. And rather than continually hiking rates in an attempt to generate inflation, continually cutting rates, now they're going to be forced to continually hike rates if inflation doesn't get under control, which I just find absolutely hilarious after all these years of basically anyone who isn't an asset holder getting shafted.
Well, I've got this theory. Of course, they're talking next Tuesday, right, on Melbourne Cup Day, and traditionally that's pretty much the last thing they're going to talk before, after Christmas, New Year, holiday break, etc. Right. So the question is, will they actually surprise everybody and say, "Oh, actually, we changed our view," or will they simply say, "We'll wait for the data"?
I would imagine the latter. I imagine they're going to suddenly become very data dependent and not, rather, myopic and focused on we're not going to raise rates for 3 years narrative.
Yes, I wonder. Remember 2024, folks? That was a long time out. And, the fact is that if those implied yield curves are anything like true, then we're looking at, what, 2 or 3 rate hikes next year?
4. I checked it again last night. It's now
Okay.
4.
Wow.
4 next year and 5 by February.
Yeah.
by February 2023.
And then suddenly the question then of, okay, what does that do to mortgage rates on these huge mortgages that people have? The financial repression that comes from that too. This is, way to play out.
Well, I mean, it might have the disastrous impact of having people who are saving for deposits and, retirees who are relying on fixed income not being forced to live on 2-minute noodles anymore. So, I mean, that's fairly clearly a disastrous series of events that, the central bank would want to avoid.
Well, you've actually given them a way out. You can now give them a story to say, actually, we've been listening to the community and all of these pensioners and all these people who can't save, right? And we now believe that actually it's the right thing to do to, move it the other way. I can see it now.
It works for me, mate. It works for me. Whatever decision, whatever justification they have to come up with to do the right thing works for me. I think that one of the things that's really interesting about the entire rates debate is that the other side is barely ever mentioned. It's all well and good to say, but more people with a mortgage are going to save X number a month. But it doesn't tell you that the fact that, retirees, people on fixed incomes, the disabled, who are relying on, fixed incomes from payouts, or people who are saving for a house deposit, that all those people are going to suffer, that all those people are going to have money pulled out of their pockets and effectively given via monetary policy to mortgage holders. So in aggregate terms, the actual increase of capital and of funds into the economy isn't nearly as large as they claim.
No, exactly. And of course, the other point is that a lot of those people on limited incomes have precisely the same cost of living pressures, right? So it isn't as though they're sort of standing still. They're actually sinking deeper and deeper into, negative territory, just trying to, keep paying the bills. So it is time, I think, to, stand back and just think more broadly than just the old mortgage sector and saving the banks.
I agree. I mean, I think, considering that we have such stringent asset limits on people here in Australia when it comes to the pension, if you're on the pension, interest rates should be, if you don't qualify for a pension, if you're a self-funded retiree and you've got too much in super, or you've got too much cash or whatever, if you've got that money sitting there, whacking it in a term deposit should get you at least as much money as it would if you were at least as much money if you were on the pension, if as a couple. I think that's realistically only fair, because at the end of the day, you're being denied something. So, and the idea is that if you have that much money, you can support yourself, without having to go and do something insanely risky, or, go buy, Shibu or whatever cryptocurrency is popular this week, Titscoin, whatever, that you should be able to afford that very, very basic standard of living because you saved all your life for that. And I think that is a relatively fair way to work things. But, monetary policy has other ideas with its dopey wealth effect and all that jazz.
Well, and also, of course, a lot of people in government are now saying, well, of course, the assumption that people shouldn't live off their capital. In other words, they should, draw down on their capital rather than actually have this massive nest egg, that they can pass down. That was never what super was about. So there is an interesting debate there about what super is for. But I agree with you that the whole idea was to allow people to live respectably without actually having to tap into the government coffers.
Yeah, and which would in turn save the government money, which would in turn allow them to spend more freely on other things, which, would hopefully, either produce something, provide for something more productive, whether it's, incentives for businesses or whatever, or whether it's the fact that it allows them to have better government services, which everybody benefits from. So, it's just this insane idea that if you have sound monetary policy, you can actually have a better society. And all it costs is not having the stupid wealth effect. Yeah, absolutely. There's a vision there somewhere. Well, why don't we go into some slides? Because I know you've got some slides, and I know how much people love the slides. So sure,
fire it up.
All right, this chart is of Chinese property sales, which, as you can see, have plummeted to multi-year lows when you exclude the initial lockdown period in China. Now, the thing that's interesting about this is that, as you can see, there's a dip every year on a seasonal basis, which is obviously distorts the data somewhat because this is a monthly chart. But if you look at it from a broader perspective and you compare, this is for September. If you compare September with other Septembers, it's very, very low. And the issue in all this as well is that China needs their property sector to at least remain static for it not to act as a drag on their economy. But that appears to be exactly what's happening. And it's going to be really interesting to see what they do from here, whether or not they turn towards infrastructure to try and become a driver of growth once more, or whether we do see some form of property-based stimulus. I mean, we have seen them try to incentivize banks to lend more, but I think as long as prices are falling and people are concerned, that's going to be a bit of a tough sell.
Yeah, and I'll make the point there, of course, there's an early November meeting that's a very critical meeting for Xi to be able to put his doctrine in and get it supported. So perhaps that is also shaping the way that they're handling things at the moment.
That is definitely a factor. I think that they're a little bit one foot on the accelerator, one foot on the brake at the moment when it comes to the property sector. Because on one hand, they are trying to incentivize banks to lend. They are trying to, basically twist their arms a little bit and tell them to support the property sector and support mortgage holders. But then on the other hand, they're proposing things like property taxes, and they're, telling people that housing isn't for speculation, it's for living, and all this other stuff. And I mean, the simple reality is that in China, 85% of new homes are sold to people who already have one or more homes. So, it's not really something where you can, take the one foot on the accelerator, one foot on the brake approach. It's something, that is arguably far more delicately balanced.
Yeah, and of course the leverage is even worse than in Australia. I mean, the property is amazingly leveraged here, but in China it's even worse, isn't it? So a lot of people basically have property as their main wealth platform.
Exactly. I mean, Chinese property is the largest asset class in the world. And some Chinese properties, when you compare them with incomes, are 40, 43, 46 times household disposable income. And that's just, I mean, that blows Sydney, Melbourne, any city in the world out of the water in terms of being unaffordable. So it really is a bit of a knife edge there. And if you take away the possibility of further capital gains, it could get ugly quite quickly, and I think that's something that is a potential on the horizon. It's not necessarily likely, but it is certainly a possibility. Another one on China: 38% of manufacturers that have been interviewed by China Beige Book, or should not interviewed, are covered by China Beige Book, have had their production hit by power cuts in some way, shape, or form, with 2% experiencing 5 to 6 days worth of manufacturing cuts due to the power crisis. Now, this is something that's really interesting in China because it's having a really, really it's having quite the butterfly effect in terms of its impact. Because on one hand, obviously, you've got firms without power, you've got goods that aren't being made, deliveries that aren't being made. And obviously, this is going to cause delays and further supply chain issues in China and throughout the world to some degree. But one of the interesting things is that because power is being intermittently interrupted, a lot of firms, a lot of households even who have the money have turned to diesel generators, which has turned around and then ironically created a shortage of diesel in parts of China. So now you've got transport and logistics companies who are struggling to find diesel fuel for their trucks to ship their orders, to do logistics across. I mean, according to an article from Bloomberg, this is happening from northeastern China all the way down to the southwestern China. So it is very much a national issue, and that could cause some rather significant problems if that isn't resolved.
Power. It's all about power, isn't it? Coal, oil, price. availability, and then of course if you overlay climate change, emissions, and I think they're trying to clear the atmosphere a bit before the Olympics next year. It's a complex issue.
It is. I mean, they want these clear skies for the 2022 Winter Olympics, but I mean, by the same token, they're ramping up coal production to absolutely nosebleed levels to stop the fact that coal is costing them an arm and a leg, and it's just making business either unprofitable or it's just causing these blackouts. So it's going to be really, really interesting to see how they balance those factors.
Absolutely.
Now, this is one of the interesting things that feeds in from the China issue. Now, a lot of German exports, things like cars, things like consumer goods, stuff like that, a lot of it flows to China. And considering the fact that Germany's economy, nearly half of it is made up of exports, it's not hard to imagine that a slowing China could really begin to slam the brakes on the German economic recovery, particularly at a time when things are becoming very, very challenging in terms of inflation. I mean, German producer prices the other day came in at a 47-year high, and that's just, it's really just off the charts. And if these sort of price pressures persist while at the same time China is having these issues, and that's going to hit the German economy, I mean, as the title of this video suggests, the dominoes may fall.
And it's interesting because I think a lot of people down here don't understand how different the German economy is from, say, our own, right? But they have a couple of interesting characteristics. A lot of local banks, of course, a very significant manufacturing base, and therefore a need to sell stuff overseas, and not just raw material stuff, but finished goods stuff, products, rather than actually just raw materials.
Yeah, which is one of the reasons why Germany is the most exposed to this global slowdown that's currently occurring. And I mean, in some ways, it's a similar story in Korea, which has seen both GDP and industrial production surprise to the downside in the last few weeks.
Absolutely, yeah.
I know I've used this particular index before, but it just keeps going. Once again, we have another record high in the number of ships anchored at LA and Long Beach harbors waiting to be offloaded, despite Joe Biden's promises that this was all going to be fixed and the ports going 24 hours was going to fix all these problems. It hasn't. And the problem actually continues to get worse.
And it's interesting because, what the fact about that is, Joe can say, keep the ports open, but all the ports are privately operated and they need drivers to be able to drive, and the containers to be available to move things. And in fact, what we've actually got ultimately is a shortage of containers simply because they're all stuck.
Yeah, exactly. And that's part of the problem as well, because ports like LA and like Long Beach are shipping back a record number of empty containers to places like China and places like Vietnam and the other manufacturing powerhouses in Asia. They're just backed up, and there is obviously that shortage of containers as well. And just another interesting addendum to this, one of the problems with the trucking industry in the US is that there has been this expectation for a long time that automation was coming, and that automation hasn't happened yet and may not happen for quite some time. And a lot of younger people haven't been going into trucking for this reason, because who wants to go in, get it, do all the training and then get a job and then be out of a job and have no other marketable skills in a decade? But the really big issue in the long term, aside from the current crunch, is that a lot of truckers are reaching retirement age in the next 4 or 5 years. And there is a very, very large proportion who are in that baby boomer cohort, people in their mid-50s to their mid-60s who are on that cusp of retirement type of place, who may retire. I mean, you're talking about 20% of the truck driving workforce in the US retiring over the next 4 or 5 years. And, that could be a real inflationary factor going forward, because training truck drivers, particularly ones with the threat of automation hanging like Damocles' sword, is very much a challenging thing for the US to come to terms with.
Well, I make the point it's not just the US, it's Europe and the UK, for example. I was looking at some data the other day to look at the age distribution of truck drivers in the UK, and a lot of them, again, are in the 55 plus and are looking ultimately to get out. They're having great difficulty of pulling younger people in, and they've had to increase the wages to try and attract people, and they've actually reduced the standards to be able to get people to come in. It's a desperate situation, and unfortunately, a lot of people say, not sure I want to do this because I'm going to get stuck in traffic jams a lot of the time, and I have to go many days without seeing my family and things. So it's not a very palatable occupation for some people, and then the wages aren't great. So maybe it's not surprising that people are voting with their feet.
No, it's not, and I think that demographic issue, not only through the transport and logistics industry, but just more broadly, is going to be something that's going to be one of the key themes going forward. And it could really create some shocks for a system and for a series of leaders who really haven't looked at how these systems work at a granular level, and have instead focused on these wider viewpoints of just-in-time logistics will always deliver.
Well, what you need, of course, is a virtual world, right? And then we can just have everybody living in the virtual world, and we can have virtual deliveries, meta. So maybe we don't need physical anymore.
Oh, well, we've got virtual housing prices and virtual stock prices, so why not? Oh, all right, next one. Now, this one is a really fascinating one. It shows how the number of imports into the US has risen significantly. It's up about 18% since the pandemic began, and this is the number of containers flowing into the US. Now, on the right, you have total retailer inventory levels, and you can see that, okay? And basically, what has occurred is, while the number of imports has risen significantly, the level of retail inventory has also risen significantly as well, and is up about 12% over the same period. So what's going to be really interesting from this point onwards is just how these two factors interact together. Because on one hand, you've got the inventory factor of, basically in a lot of these manufacturing hubs, these logistics hubs, that you can't get the warehouse space. So that, that you're trying to, cram a fire hose worth of goods through a garden hose, and obviously it's just not working. But I think that raises an interesting point in the longer term, just of, are inventories higher than we expect, and are certain products that aren't as in demand potentially going to create some deflationary forces in the longer term if demand does start to come off. So it is quite an interesting conundrum to sort of approach, and it's one where it's really hard to know. I mean, also inflation is a major issue in all of this, so that could be distorting the picture as well. So it's really, like so many things in all of this, it's really hard to know which way all this is going to go.
And of course, the argument in the US has been, well, people bought a lot of stuff because they weren't traveling and couldn't go to places to get certain services, so they just bought things. But the inventory rise would suggest that maybe it's not universally the case. The other point to make is that inventory costs, right? Because basically, you might have, a certain amount of trade finance or what have you, but ultimately, if you're actually holding large stocks of inventory, there's a dollar cost attached to it too. So that's a very inefficient economy.
It is, and that's something that could potentially create further inflationary impulses as companies expand their warehousing and their logistics to be able to have greater levels of stock on hand. So if that is a permanent shift, then perhaps there is a more inflationary future down the road, at least in that particular avenue.
Or I suppose the other turn of phrase would be, if they suddenly start buying services and stop buying things, you could have these massive stocks of inventory that never get sold and gets discounted deeply, and that creates another well of problem.
Well, I think that's somewhat inevitable at this point. They keep businesses just keep making these larger and larger orders in the hope that that one thing or another is going to get through to them in time. And eventually, I've heard these stories, on a granular level in my local area, whether it's the local hairdresser ordering additional dye because they're not sure they're gonna get it in time, or that there could be future issues with shortages, all the way up to building suppliers. So, it really, I think there really is going to be a disinflation or deflationary impulse from these inventory issues at some point, but the question is when that's going to happen. I mean, it's still, with all these excess savings remaining in certain demographics, it still could be years away.
Absolutely, yeah. It'll shake out eventually.
Yeah. Now, this is an interesting one, talking about the bond yield factor that we were discussing earlier. Now, the Aussie 3-year bond yield has risen from around about 0.2% in September to 1.245% earlier today. And on the right there, I've got the net interest margin that the Big Four generally collect on mortgages. Now, it's important to keep in mind that that's not what the net interest margin would be on new loans, where the banks tend to give you a very good deal, lower rates, etc. And it also doesn't really take into account how well the banks did out of fixed loans when they did the 2 and 3 year fixed loans, as a result of the RBA providing them with 0.1% funding through the term funding facility. But what it does show is that basically these cheap fixed rate loans are going to be coming to an end, and in relatively short order, if these bond yields remain at this level, or even if they just remain in this ballpark, because the bank's net interest margins are slowly going to be eroded, and they're not going to be terribly happy with that. So, the banks are going to maintain their profitability, and that's just the way it is.
And of course, 2 points there. The first is we know that there are a number of people who've locked in for, say, 3 years or 4 years at a low rate. Down the track, they'll have to refinance that loan. It'll be at a much higher rate. That's going to be quite a shock. In some cases, they've got interest-only loans, and they probably will have to look whether they can continue interest only or whether they'll change. The other point, though, is that have you noticed how the banks have been tweaking their rates? So effectively they're putting up the fixed rates, but they've been offering deep discounts on the variable rate loans, because what they're trying to do now is to funnel people into variable rates, which insulates the banks from potential movements, because of course they can just move the interest rate up, and variable rate loans of course are always exposed if interest rates rise. So the banks will look after their margins, thank you very much, never mind what happens to individual borrowers.
Well, I think that's one of the key things in the entire debate, is that, there's this idea that, housing prices will always be saved, but the banks the banks care first and foremost about their profits. And also, if the way they're going to look at it is, if you can't take a 1% rate rise, you shouldn't. Big whoop. They don't. It's not. They don't really care. I mean, I think that some folks need to revisit the actions of the banks that were uncovered by the Royal Commission.
Well, nothing has changed. We know that the lending standards are still pretty loose, and APRA moved the up by 2.5% to 3%, right, to try and actually put a bit of an extra buffer in there. But what I find in my surveys, Tarric, and it's a very concerning finding, and that is that a lot of people assume if the bank says you can have the loan, they automatically assume that they can afford the loan, right? The bank is not actually making an assessment on the same basis. All they want is cash flow over time, right? Never mind what pressure you might be under from your financial position. And the responsible lending obligations really are very, very weak even now, and I know that there was an attempt to try and even remove those. So I do worry that many people have got these really big loans at very low interest rates and have not thought through the exposure ahead if rates do move up.
Unfortunately, that appears to be the case, and I think one of the really interesting things at this point is that we could see the RBA and the Fed and other central banks basically hiking into recession or stagnation. And for the moment, okay, we've got all these these people with all these so-called excess savings, but a bunch of wealthy people going out and spending and going on holiday to the Whitsundays or wherever isn't really going to benefit the economy as broad-based growth. So we may see decent headline growth, particularly if the Liberal Party get their wish and we see immigration go back to the moon. But in terms of how things are going to be for households, it might be quite a lot more challenging. So it's really going to be an interesting next couple of years, because if we do see these inflationary pressures continue, I mean, as the bond market has shown recently, the RBA might not have a whole lot of choice. They'll be dragged kicking and screaming to hike rates.
Well, 2 points there. Firstly, of course, the term funding facility, which was that now 0.1% money, that's still on the bank's books for another 2.5 years, right? That's courtesy of the taxpayer and the RBA. So the banks are being helped out remarkably with really, really cheap funds in the short term. The other point is, did you see Christopher Joy's article today? He basically reversed the argument to say, well, 100 basis points, that if mortgage rates go up by 100 basis points, that's a 20% drop in prices.
Yeah, well, I mean, he said 15 to 25%, and the RBA said 33%. And, I mean, but it just goes to show how fragile this is at this point in the cycle, because, I mean, sure, the RBA can take rates negative and they could probably bring a bit more out of the market in terms of price appreciation. But if we are entering this inflationary future, things could get quite challenging for housing prices. And, I mean, who knows? It could really potentially go pear-shaped.
Well, there's always that risk, of course. I run different scenarios, inflationary, deflationary, and how it all plays out. But remember, there's in absolute terms, the amount of debt we've got relative to income is off the scale. And we also know, of course, that the biggest lever in terms of house price movements up or down is credit availability. So if credit tightening, higher interest rates, even lifting lending standards, any of that comes in, that's all going to have a very depressive effect on property prices. Ultimately, the other point is that, everyone's quoting the sort of, it's been a boom time for property, right? As though it's universal. It's not. In fact, there are still many suburbs, particularly high-rise suburbs, where prices are lower than they were in 2017, even now North Ryde being one example, right? So again, don't let truth get in the way of a good story, right? But of course, everybody just picks the high-level number. They never actually look at it in detail. It's a much, much more granular picture as to where prices have actually been very strong and remain strong. But many other areas, the strength is just not there even now. And we're starting with 42% of households in mortgage stress at the moment, which is an all-time high with these very, very low interest rates. So the question is, where is the get out of jail card now coming from? If rates are going to go up, if we're not going to see a significant momentum coming back into the economy, which of course is what the Reserve Bank was hoping, maybe it's wages growth, or maybe it's not wages growth.
Well, we might see some wages growth for a little while before we bring back the 700,000 temporary migrants who have left. Yes. But I mean, the thing is, if you think about that, you think about bringing back that many migrants, you think about the fact that they have a much higher workforce participation rate than the average Australian in the prime age group, and you're literally talking about adding 2 or 3% of the labour force in a year, and just like that, and that doesn't even include the other migrants that you're bringing in on a more permanent basis. So it's like, and then the RBA and the government scratch their head and go, why isn't there any wages growth? And it's like, because you're expanding the workforce enormously every year. Of course there isn't going to be wages growth.
Well, it's the People's Quantitative Easing Program, right? That's basically what it was. It was basically, that's how you inflate the economy, right? You just bring more people in. But it's interesting, of course, the Reserve Bank the other month basically made the point that actually reducing migration helps wages growth. So the reverse is also true.
Yep. And unfortunately, better per capita growth isn't as good to headline GDP as just bringing in more migrants. So. Yep. Unfortunately, I think we know which way the political system is going to go on this one.
Yes. Was it Dominic Perrottet who said 2 million in New South Wales? Is that right?
Oh God! Can you imagine? I mean, I just love the fact that 1 minute Scott Morrison's like, we're going to get to net zero by 2050, and the best way to get to net zero is to import 400,000 people a year exactly. And raise their living standards and their emissions to the same as Australia. It's like, yeah, guys, great idea. Oh, Lord. Okay. Now, this one I thought was really interesting. It basically shows that the percentage of workers reporting a pay rise is actually less than 40%.
Mm.
And I think that really just rams home the challenging economic environment we find ourselves in. There's always this idea, particularly when it comes to the housing market, that it's like, oh, but wages are going to grow and things are going to get easier for people. And it's like, well, not according to this chart and according to the Melbourne Institute and the Australian Bureau of Statistics. So it really paints a very challenging picture for the broader economy, just that wage growth is increasingly concentrated in those in-demand professions, and frankly, generally speaking, in those more well-off demographics in terms of income and wealth.
Yeah, and in fact, I've done some analysis on this from my surveys, and you can see the stagnant wage situation in huge swathes of households, right, in certain sectors. But there are a few bright spots, the finance sector, the high-tech sector being two examples. Education was doing quite well at one stage, and that's fallen off a log now. But a lot of people have seen no real wages growth since 2011 at all. And it's interesting also in my surveys, one of the things I'm picking up now is people are saying, well, the only way I can get my income up is to change jobs. So there's now a significant spike of people looking to switch jobs over the next 6 months or so, with an attempt specifically to try and lift wages that way, because they can't wait for wages to arrive where they're working at the moment.
Well, you're making the point about wages not rising since 2011 raises an interesting issue, because back at the end of 2010, which was when November 2010, which is when rates were last raised by the RBA, 65% of people were reporting a pay rise.
Mm.
And today it's less than 40. So it really illustrates to a very strong degree just how challenging a rate hike or a rate hike cycle now would be, because back then 2/3 of people had rising wages and people were able to cope with that. Today it's less than 40%. And excuse me, not only that, but back then a rise in the cash rate from 6.5 to 6.75% wasn't really that big of a deal, because in relative terms, 0.25% on top of 6.5 is relatively small, but 0.25 on top of 0.1 is huge. And even if you look at it from the perspective of the RBA's own number on the variable rate, it's basically going to increase households' repayments in terms of interest repayments by about somewhere between 8 and 9%. So, and that's just one rate hike. You factor in multiple rate hikes, and then all of a sudden things start to get really interesting. So it could be quite a challenging time, especially for an economy that's got accustomed to rates only going one way.
And overlay higher costs, which you're seeing in a number of areas too. And of course, just the other point is people have much bigger mortgages. So as well as the differential move of, a small percentage, on a small rate, a percentage has a much bigger impact. The bigger mortgage means that actually the dollar amount is also bigger. And that's the other point that people haven't got their heads around, whilst people are saying, well, the total repayments that people are making are roughly similar or slightly lower to where they were, 5 or 6 years ago. That changes very quickly with even small increases in rates because of the bigger loans that are now being made.
No, exactly. And that's an important point. The AFR the other day had a graph showing what proportion of household income was spent on interest repayments, principal repayments, etc.
Mm-hmm.
And the proportion being spent on interest repayments is at its lowest level ever,
Yep.
by quite a significant margin. And if you compare it with sort of even 5 or 10 years ago, it's come down significantly. So if you see now, particularly as you say, with large mortgages, and you see rates rise, that could rise quite significantly and put a fair amount of pressure on households. So, once again, things could get quite interesting if the future is inflationary.
Well, as I keep saying to people, remember, folks, you're a cash flow. That's how the bank thinks about you. As long as you go on paying that monthly payment, just keep paying it, even if they have to extend the length of the mortgage or interest only. They don't worry about that. Just keep paying. You are a cash flow.
Unfortunately so. Now, this one I just thought was funny that I made this yesterday, and it shows basically where rate where Aussie cash rate futures were on Wednesday and then where they were on Thursday. And it shows basically how quickly the rate hike narrative is evolving. And as of yesterday, by the end of next year, there are now 4 rate hikes priced in. So Christopher Joy is 1% worth of rate hikes that he was talking about in his article. Kicking housing prices down 15 to 25% is effectively already priced in by the market. Now, it is important to note that just because the market prices it in, it doesn't mean that it's going to happen. The market can be wrong, and the market often is wrong. But it certainly would be interesting to see it if it did happen. And also considering the fact that we've seen even more rises in the bond rates today in quite a substantial way, I wouldn't be surprised if the chart looks even more different than this by the time we see the market close later tonight.
Well, just to make the point there, Tarric, that movement over 24 hours, that's a pretty big movement. It doesn't often happen like that, right? So it shows that there's been a substantial change in the weather over that 24-hour period. So the market's thinking very differently. And it's also interesting that the Reserve Bank didn't do anything to counter the change. They didn't go back in and try and actually reassert their authority on the yield curve control, which suggests to me that they have actually given up.
Yeah, no, I agree. I mean, if they were going to intervene, yesterday was the time to intervene.
Yep. And
they didn't. So, I mean, intervening now when the bond yield they target for their yield curve control has risen by 600%, it's kind of a bit like, closing the gate after the horse has already bolted and already been turned into glue at this point.
Yeah, well, maybe they should go into glue production. They'll have more success than protecting the economy. I don't know, just a thought.
Well, I mean, if they could make one little thing of glue for a primary school, they would already be more successful than they have been with monetary policy.
Yeah, that would be a really good measure of productivity.
Well, I mean, if your productivity is 0, it's not too difficult to get it above that.
Exactly.
All right. Well, that's it for the charts for today.
Brilliant. Tarric, thank you for those. What I love about those charts is it really just helped us tell the story. And it's a really complex story, as we said. So I appreciate your work putting them together. They really help.
No worries, mate. I'm glad the audience enjoys them.
They certainly seem to. Yeah, it's good. Now, before we finish today, we should just touch on one last thing, right? Because this week we had the announcement from the government about net zero by 2050, right? And I don't know what you think, but when I listened to it, I thought, well, one, nothing has really changed, right? They haven't, they've just picked up policies from years ago and just continue to peddle them. But secondly, it was just a marketing spin.
Yeah, but I mean, that's what they're good at. I mean, but at the end of the day, I mean, if it proves to be effective, that's just the way it is. That's the way the government runs things. The announcement effect and all that. And I mean, I can't say. I mean, when I read through the paperwork, I wasn't surprised. I mean, but unstated increases to technology, all this other stuff that that's on the never. It's classic Scott Morrison. Although I'll be interested to see if he gets a boost in the polls out of it. I'm not sure.
No, it was interesting because the IMF basically said, I think it was the IMF said, don't bank your future on unknown technological solutions.
Well, I mean, we're a nation that has bet on the wealth effect. So, I mean, I suppose it's kind of just variations on a theme to sort of bet the national future on this. What would you call it? Just this incredibly vague force that you just hope will deliver the outcomes that you want.
Well, the beauty of course, is it's too far out, so that they won't be in power. They won't themselves be. I mean, the party might be, but they themselves will be, somewhere else by then. So, that's been, I think, the problem a long way along with this thing, that it's almost too far over the horizon. And yet, what I always have said is, the sooner you start taking the steps, the easier it is. The longer you leave it, the more difficult it is to be able to actually make the changes that you need to be able to make, to be able to tackle, which I still regard as a fundamentally important thing to tackle. And it's interesting that even News Corp has sort of swung in behind it now. So, even the mainstream media is pretty much beginning to talk the same talk. But the politicians, they're still playing around with marketing and spin and, not too much real detail.
If you look at the time that Scott Morrison and his crew have been in government, and you look at the policies that have been introduced, you haven't seen anything that you would consider especially visionary, especially complicated, especially big thinking. It's all been, tinkering around the edges at best and pushing an ideological agenda at worst. So really, I mean, I don't know. Like sometimes I look at it and I just go, could they even put together a net zero policy that would work? That would tick all the boxes that they want it to tick, while still being something that they could sell to their base and to the broader electorate. I mean, I don't even know. I mean, that's something that's a real issue with this government, because I mean they're just static. They're just there. They just exist.
They're occupying the space, right?
Yeah, exactly. They occupy the space. They don't really accomplish a whole lot. They thrive on controversy and all these different things, but at the end of the day, they don't really accomplish a whole lot. And I think that that's really sad, because I know a lot of people who support the Liberal Party. I have friends and family who are rank and file members of the Liberal Party, who do have this vision for a better Australia and a better future, and action on the issues that matter. But the government has instead come up with this very cunning, admittedly politically cunning strategy to basically do very little, but continue to get elected and remain in power.
Yeah, absolutely. And, I sometimes think that politicians are fixated on getting re-elected, right? And so they'll say anything, do anything to try and keep that process. Unfortunately, the electorate in Australia, whilst there are some, very smart people around, a lot of them are a bit busy down at the beach and, doing other things. So maybe they don't pay enough attention to what's going on, and then they think about the hip pocket and, well, it sounds as though that could be slightly better, so they sort of vote on the hip pocket rather than maybe on some of the strategic issues which perhaps are, there for those who want to think about them. It's an interesting commentary on the way politicians, the political system and the electoral system actually works.
It is. I think that it speaks to a sort of voter disempowerment, for want of a better phrase, of an electorate that feels like what they think doesn't really matter, because say for example the issue of immigration. People get asked by pollsters, by universities, by these academic studies year after year, do you want lower immigration? And pretty much every study says yes. Some of them overwhelmingly so. Some people have written to their local federal MPs. They've written to the Prime Minister, etc., etc. But they don't listen. They just keep doing what they want to do. What they choose is what they believe is well, I don't even know if they believe it's better. You'd have to ask them. But what their narrative says is better. And I just think people feel like their voice doesn't really matter, and they're just like, oh well, whatever, and they've just disengaged from it all. And I mean, we are at a point where most people can't. Where I would say a majority, and this is a fact, I might add, not just my opinion, where a majority of people can't name someone in federal cabinet who isn't the Prime Minister or the Treasurer. So people just don't really care. And to be completely honest with you, looking at the way that politics has been treated here in Australia and how people's voices have been ignored, I don't really blame them.
Well, it is an echo, of course, not just here, but in other countries too, right? I mean, the UK, I know very well, and similar things there as well. So, Boris is doing whatever it takes to get re-elected. The budget that came out this week in the UK was not really a conservative budget. It was a big spend budget, right? But it was all designed to allow them to be able to cut later, taxes particularly, to be able to get re-elected. So again, you see the politics driving everything rather than actually what's good for the country. It
does. But I mean, I think the truth is that it happens because we allow them to get away with it. We allow them to. I mean, Australia, and this is perhaps the perfect example. You've got sports rights. You've got the issues with the car parks. You've got issues with grants in regional areas going 90% to coalition seats. well, I should say disproportionately to coalition seats rather than, because obviously the coalition does hold a larger percentage of seats in the bush, but it speaks to the broader issue of the fact that no one cares. I remember controversy. It's like, oh, Paul Keating had a pig farm that he didn't properly declare, or this bloke brought in a teddy bear that he didn't declare. And, here we are, them pissing away billions of dollars worth of our money on pork barreling, very, very clear pork barreling, not the clever kind where it's like, well, we're going to tweak this a little here, tweak this a little there, that, is unfortunately just part of the political system. It's, rather blatant, and people don't care. I care. I imagine that a lot of our viewers care, but unfortunately, the public doesn't really.
No, absolutely. And, I don't know whether you saw it, but there was a Treasury statement that was made in one of the reviews quite recently, and they went through a whole bunch of stuff. But one of the things that really stood out for me was the justification for running JobKeeper the way they ran it, right? Which basically was no checks, no balances, et cetera, right? And they basically, praise themselves for an innovative strategy and claim that it was the perfect solution to the problem, but no recognition of the rorting that went on and the billions of dollars that were wasted. That to me is an archetypal example of the issue we've actually got.
It is, and the thing that really gets me about JobKeeper is that one, Treasury members people in Treasury recommended that there'd be a clawback mechanism because they thought that something like this might happen and companies that don't need it would have been effectively overpaid, and that we should be able to get back our $40 billion. But then Treasury and senior Treasury officials in the government shot that down. But as for the issues that you mentioned, it's just a bit ridiculous that the public doesn't care that they pissed away $40 billion of our money.
Yep.
Now, okay, you can, the MMT thing, whatever, but at the end of the day, we are paying the interest on that money. Yes. And we are seeing the less government spending on services, the less, whatever. You're seeing the impact on the public, and no one cares. For years and years, it was like Labor spent $1 billion and pissed this away on the school halls, and they pissed this away on this infrastructure that cost $1.5 billion more than it should have. And don't get me wrong, I'm against government waste. And at the time, I was like, yeah, Labor should be held accountable for that. But by the same token, so should the Liberal Party.
Absolutely. Yeah, well, unfortunately, the truth often is that, a lot goes on that shouldn't go on. I just hope voters, when they come to the next election, remember some of the things that went under the bridge, right? And don't just react to the hip pocket opportunity and the rorting and the buying of votes that will go on directly or indirectly, right? Because there are some principles here which I think are pretty important, and actually, if we make the right decision, we can shape the future much better than we have over the last decade. But hey, I'm probably just an optimist. The other point I'd make is all that government debt, if rates do start going up quicker, it's going to cost a lot more.
It is going to cost a lot more. In a way, they're quite lucky. The fact that the RBA basically owns a third of Aussie government debt now, and that's obviously, they're effectively paying themselves, which then goes back into the federal budget. And but by the same token, as you say, if rates do rise very significantly, and we are part of an inflationary cycle, I think that the issue isn't going to be so much a financial one, but it's going to become a political one. Because they are going to be spending more of the budget, a larger proportion of the budget, on debt servicing than they were before. Because it's all about year-on-year changes. It's not about what it was, 5 years ago and going, things are so much cheaper, things are better now. It's, this person is spending 57% more than it was in, May of 2020, even though we forget the fact that May of 2020 bond yields have absolutely collapsed. But it doesn't matter. It's about the political narrative that can be sewn together. So, it's going to be really interesting because, all I can say is, people say to me, austerity is not going to happen. It will happen to some degree. There will be cuts to things that people need. I will make that call right now, and I will die on that hill. And if I'm wrong, and if we get to the end of the next parliamentary term and nothing has been cut, I will come on this show and I will say I was wrong. But I won't be.
Yeah. No, unfortunately, the UK is a good example, right? So amidst of all this budget largesse, they've made significant cuts in some very uncomfortable places for a lot of people. So again, it's wherever you look, I'm sure you're going to be right, unfortunately.
Yeah, and the only sorry, I'm just throwing one last word. And the only reason it hasn't happened is because we've got an election coming up.
Absolutely, that's the point. It's all about the election cycle. Tarric, as always, very insightful. I really appreciate your time. I've got this picture of these dominoes, tottering. Are they going to fall? Are they going to fall? It's a bit like it could go this way, it could go that way, right?
It's going to be fascinating to watch one way or another. Whether we get a deflationary future, an inflationary future, things are going to be interesting. Obviously, I've in the past espoused the deflationary future thing, but there is a certain part of me that would like to see an inflationary future prompt some more reasonable interest rates that could start to somewhat equalize our society for the better. Not in an overly redistributive way, but just in the way it was before, the way we know works better.
Absolutely. Well, there are decisions that could be taken. There are policies that could be set that could absolutely change the trajectory of the economy to a much better place. And, I keep coming back to that point. There are choices that could be taken, and the fact that people aren't taking those choices and are deliberately playing with, politics rather than actually these choices tells you a whole lot.
Unfortunately so.
Tarric, thanks very much. We'll do it again soon.
No worries, mate. Catch you later.
See ya. Bye.